Hello, hello, you lucky people. James here, as ever, for today's ACCA Management Accounting F2 examination video, where I'm going to walk and talk you through from start to finish a full computer-based examination paper available to you on ACCA's website for free. Now, if this is the first video you've ever clicked on of mine, hello, hello, my name is James. I'm an ACCA qualified member from the UK, and on my channel I help out ACCA students pass their examinations for free. So if that is of interest to you, be sure to subscribe below so you get access to all my free materials. And as ever, I dedicate all my videos to my lovely subscribers, today being no different because there is such demand for this video, and hence it is a bit long, but as you can see, you get 2 hours to complete it. So make sure you stay to the end. I'm going to go through every single question if I was in your shoes, because as you can see on the screen, it's to help my lovely subscribers out. So we've got Fires down there, we've got Early Karma. Clearly Early Karma watched my actual full CBE F1 review, so hence we're going to do the F2 review now. And Fire as well, it's dedicated to you. I also put a poll out on this on my Instagram, as you can see on the screen as well. 71% of people would like this video. I really think it's going to be the difference in lots of people passing. So be sure to subscribe, so as I said, so you get access to all my free videos. Leave me a comment how you got on attempting this, what you thought of the video. And as ever, thank you so much for all the support for the channel. I really appreciate it if you gave the video a massive like and thumbs up. I mean, as you can see behind me, it's a lovely sunny day. I'm treating myself on a Friday to 2 hours of management accounting. What could possibly be more entertaining than that? If you are starting out on your management accounting journey, I put all the recommended books, resources, tools that I'd be using to help you pass the exam. So check out the description below. And you can also find the link down there where to access the CBE exam that we're going through on the screen, so that if you click the link down below, it's going to take you onto the ACCA's website, click the specimen exam and MTQs on there, and then go on to the actual main and full exam, where you can attempt it either yourself, which I would highly recommend that you do, or you can stick with me all the way to the end of the video, and I'll walk and talk you through as best I can what I was thinking, looking at all these different questions, and giving you an insight as to say what would be the best thing to help you pass it. So before we get kicked off, make sure you've got a pen and paper. I've got my cup of tea here to keep me going. It's 2 hours. It's going to be tricky. I'm going to have to concentrate for once. For section A, so that you understand the timings as well, it's 1.2 minutes per mark in this examination. You've got 120 minutes for 100 marks, so that's 1 hour and 24 minutes, or 84 minutes for section A, and only 36 minutes for section B on there, because you've got 30 marks on it. So that's just a rough estimation if you're going to be giving it a go yourself. And we're looking, as you can see on there, for a pass mark of 50%. I'm going to do my best for you today, so you've got to stick around through the whole video. Enjoy it. As I said, leave me a comment below how you got on with this exam question. Any other video requests that you'd like me to do, and more than happy to help. So without any further ado, I think we should get kicked off here. I have got my top-notch, high-quality computer calculator for our high premium budget channel ready to help me out as we go through. So let's get cracking. Let's start to have a look through. And again, you've got all the processes. I'm not going to waste your time going through that. You can read them in your own time. But this is how you would actually start at your CBE examination, just like this button on here. So I think we should get going. 3, 2, 1. Lovely stuff. So as you can see, the time is going to be ticking down for us up at the top. And we're just going to go through section A first, then on to section B, and then see how we get on. Who knows? Even enjoy it. So stick with me on this. The first question we have on today is a manufacturing company benchmarks the performance of its accounts receivable department, so that's customers who owe us money, with that of a leading credit card company on there. So you've got a manufacturing company benchmarking against a credit card company. And again, I'll try and word the questions to say that you can answer it as we go through on there. I'll just walk and talk it through what I was thinking if I was an ACCA student, like the good old days, as to what I'd be thinking as a potential answer on these. So which type of benchmarking is the company using on there? So first of all, we've got strategic benchmarking. Well, it's not looking at that because we've got a different actual company here, not necessarily competitor, but it's in a different market. Strategic benchmarking is all about actually finding a competitor who we can actually follow on there. Functional is looking pretty good on there because we're looking at how it could be operationally put into practice, even though it is using an external party. It's not going to be internal at the bottom because we're actually using an external party, as I just said. And finally, it's not going to be competitive because the credit card company is not in our industry. So the bottom line there is that it's going to be functional based on that the actual credit card company is going to have an accounts receivable department. Yes, it is external, but it's all about how it would be benchmarking from that operational area for the accounts receivable department. So unlike in your examination, you can see that as I click the correct answer, it showed the right one up at the top. That, of course, would not happen in your exam, but we'll just keep going through it as if it would be. Again, I'll be highlighting different areas of the CBE platform to help you out. Everything from the actual test progress, you've got the different references at the bottom, and if you need any help or flagging questions. Next one on here, we've got which of the following best describes target costing on there. So first of all, you've got to say what target costing is, and that is finding out what our price point is that we're going to be looking at for a particular product or service in the future on there. So just read it through, and which of the following best describes actual target costing that we're looking to actually hit. So first of all, setting a cost by subtracting a desired profit margin from a competitive market price on there, which again would give us a pretty good estimate on what a reasonable target cost would be. Next option we have is setting a price by adding a desired profit margin to a production cost. Right, okay, well that sounds to me like cost plus pricing on there, but at least we've got a bit of production, but I'm going on option 1 so far. Next one, we've got setting a cost for the use in the calculation of variances. Well, variances, as we'll see as we go through this CBE, is all about saying, well, what did we expect to happen versus what actually happened? And I'm not sure what setting a cost for the use and calculation is, and you'll get these answers in your exam which you go, that can't possibly be right on there, and that is one of them. Finally, setting a selling price for the company to aim for in the long run. Well, that has nothing to do with actual costing. Again, it's just a sort of outlier answer. So the most specific one that we can see on there is the top one. It talks about the desired profit margin, a competitive market price that is actually achievable, and by subtracting that profit margin less the competitive price, that is going to give us a target cost that we need to be hitting in order to actually be profitable and so that the business can function. So definitely the top one. But notice how I'm just trying to walk and talk it through to myself logically as we go through. Now we've got on here, again, when I look at these kind of questions, I go straight for the bits in bold because they're what the examiner wants to stand out for you, and also the requirements. So for each process, and before we look at any of the figures, for each process there was an abnormal loss or an abnormal gain, process F or process G. The information relating to the two processes F and G were as follows. We've got a normal loss, the input litres and the output. So I think we're actually going to need the calculator on this, because what it's saying here is from those input litres, based on we have a loss percentage, so it's saying that for process F we've got a loss percentage or normal loss percentage of 8%. So it's saying that 92% of those litres will be converted into the output litres. So think about it being maybe oil drilled down to the ground, that you drill the oil out and then maybe only actually 92% of that actually gets filtered and produced into the output that you'd have petrol or diesel on there. So the way you'd calculate that is you've got your 65,000, this is for process F, and it's saying we've got a normal loss percentage of input. Notice how input. So I'm going to multiply that by 0.92. So 8% is 0.08. So if I multiply it by 0.92, this is going to show me how many output litres there should have been based on that normal loss percentage on there. And it should have been 59,800. So what we actually had on there was an output litres of 58,900. So we've actually had less output than we were expecting. So that is going to be an abnormal loss for the first one on there. Notice how it hasn't come on yet. We need to get them both right for this. So pulling up the calculator again, same process for G on here now. So we'll take the 37,500, multiply that by, and don't make the silly mistake by putting in the same figure, it's 0.95, and that gives us 35,625. So that is what the 35,625 is what we're expecting to gain in terms of an output, but what we actually received was 35,700. So on there, we've actually got an abnormal gain for it because we've achieved more than we were expecting. Lovely stuff. 2 out of 2. Now, what have we got on here? Let's pull up the calculator again. This looks like it needs calculations. That's the reason why on there. So we've now got on here, again, what would be the profit for the next period using, marginal costing. So this is all about marginal costing, is all on the basis of it's measured based on contribution or the variable costs of the actual product. And the following budget information relates to manufacturing company for the next period. It's taking into account the actual fixed costs, the fixed selling costs we've got on there, production, sales. The normal level of activity is 14,000 units per period. Using absorption costing, the profit for next period has been calculated at 36,000. So this is knowing the difference between marginal costing and then changing to actual absorption costing. So absorption costing absorbs all of the actual fixed production costs within that $36,000 on there. So what we're saying now is what will be the profit for the next period if we change that from absorption costing to actual marginal costing on here. Now the first thing we actually need to work out is the level of inventory and the change on here. So the first thing I've got to say is, try to picture what's actually going on here. And I'm going to do my best to multitask by talking to you, calculations, read the question. But then we have, think about it, that if we're actually in that manufacturing company, we've got production of 14,000 on there. So that's how many we've made, minus how many we have sold on there. So that is going to give us on there 2,000 units that we have actually at the end of the period. Now with that, that means that the actual absorption costing profit is going to be higher than marginal costing due to the way it absorbs the cost. So within that absorption costing, it's already factored in that $63,000 of production costs within the production. So what we need to do now is take that $63,000, and I've got to be super duper careful on my lovely calculator here, divide it by the actual 14,000 for the production units on there. And what this is going to do is give us a rate that we're going to multiply by, remember those closing units of 2,000 that we have left in stock at the end, which counts to the profit. So this is where it's now going to give us the amount that we need to change for the profit from comparing absorption to marginal. So this is now that 9,000. Think about it this way. It's taking out the factor of how we've absorbed the fixed production costs within absorption costing. And now we're going to take that away from the 36,000 minus the 9,000 on there that we just had. And that is going to give us $27,000. Remember, it's not given us in thousands. That is now going to be the marginal cost profit for the actual period on that. So we've taken out the absorbed cost on there for the fixed costs, and now we've reallocated them based on the actual closing inventory, which marginal costing factors it in a different manner. That is where you get one of the differences between the two methods. Moving swiftly on, and you think, crikey, James, question 5, got a big paragraph on there. Don't worry, just break it down, go straight to the requirement first. Which of the following factors should not be allowed for when comparing the return on capital employed of the two organisations to assess the efficiency of their management? Okay, so not allowed when comparing the return on capital employed of the two organisations, so that's what's going to be in the paragraph up above, to assess the efficiency of the management. So quickly having a look through, because we've got to be time pressured on this. Eastland Postal Service is government owned. The government requires it to provide a parcel delivery service to every home and business in Eastland at a low price which is set by the government. Okay. Express Couriers Co. is a privately owned parcel delivery company. So that's the two companies they're referring to in the requirement. That also operates in Eastland. It is not subject to government regulation, and most of the deliveries are to large businesses located in Eastland's capital city. So just background information, you have been asked to assess the relative efficiency of management of the two organisations. Right, I can see where this is going now. Key thing on here is efficiency on there and how it is being measured. So think to yourself, again, look back at the requirement. Which of the following factors should not be allowed when comparing return on capital employed of the two organisations to assess their efficiency for their management? So this is all about what can be measured effectively or not. Well, the first thing is that some of these on here, we've got differences in workforce motivation, differences in objectives pursued, differences in geographical areas served, and differences in prices charged. Well, the first one that leaps out on me on there that should not be allowed to be compared is the motivation, because that is so subjective as to say, how could you define that one person or one workforce is more motivated than the other? We need a more objective approach on this, and something that's more the others are more quantifiable, that you've got to say the differences in objectives pursued. So could we measure that if an objective was achieved or not? Of course we could. That could be linked into return on capital employed. Geographical areas served, well, we can physically locate them where they are. And differences in prices charged, well, that's going to be recorded and measured within the management accounting department. So the subjective one that should not be allowed when comparing the return on capital employed of organisations being the factor of motivation in my book on there. So as you can see, just walk and talk these questions through. Some of them are designed to actually throw you off a bit. But like on here, just a nice little sentence. Under which sampling method does every member of the target population have an equal chance of being in the sample? So again, picture in your mind a population in front of you, whichever country you're from, watching this on there. And if you actually had to do a sampling method to say that every single member of that population had a chance of being selected, which one of these is going to be a potential option on there? So this is where we've actually got on here now. We've got cluster, sampling, I don't need my calculator on this, random, and also stratified on there. So cluster sampling is all about actually just saying, right, so we're just going to go to that area there, find a cluster of people and pick out of that area. So we'll just avoid the others on the side. It may be in a different location of a country. So it's not that. The actual systematic sampling on there is, imagine if you had all of the people in the sample all lined up in a row. And what the systematic sampling does is it picks the first, it goes along the line and picks the first 10, then the next person who's 10th in the line, then the next person who's 10th in the line. So not everyone has a chance of being actually sampled on there. Stratified for the actual sampling is all about working out subpopulations. So you've got the whole target population, then you've got different subpopulations, and from that you take from the subpopulation, right, we're going to pick out that one, and then we're going to do a little sample of that. So that is where the only one it could possibly be is a random one on there. So it could be something on the lines of like jury duty that it could relate to. So just to give you a bit of perspective, what to be actually looking for as you have a look on these sort of questions to help you out. So next we have a company. Right, what is what is the budgeted raw material purchases for next period? Okay, so this is where, if you ever see about these kind of questions, what is the budgeted raw materials? Keyword to get down on here is all about the purchases on here. Because what we have to consider is what we're going to sell, plus what we had for the closing amount, less what we had opening, and that is going to tell us how much we actually purchased. And this is where you've got to be key on this to say, right, what have we got in terms of physical units? And then from those units, how much raw materials would they require? So they're the key things to get down in your notes from this question. And the company manufactures and sells one product which requires 8 kilograms of raw materials in its manufacture. Okay, 8 grams. So one unit requires 8 kilograms on there. The budgeted data relating to the next period are as follows. Okay, rock and roll. So we've got to go through the actual units first of all. So let me pull up the calculator, clear everything off on there. So like we said on this one, we need to take the sales. So there's my 19,000, working that through. We've got to add what we had at the end of the period for the 3,000. Remember, this is in terms of units, so don't think of it in terms of the kilograms for the raw materials. Yeah, we need to work out those first. Less the actual, so that's 22,000 less the 4,000 on there, equal to, so 18,000 actual purchase for the change in units on there that we actually have for production budget for in terms of units. Now from that 18,000, we need to work out how many raw materials that relates to. That is 144,000 raw materials, and based on our current closing, so I'm going into multitask mode again, 53,000 was our closing for you to get down, and now you've got to think, right James, I've added the closing, I'm going to less the opening, and that gives me 147,000 actual budgeted raw material purchases required for the next period to meet the demands. So 147, 1, 2, 3, spot on. That is where it comes from, but the key formula to get down was the actual sales plus the closing less the opening, and then that is going to get you your budgeted amount required for the period on there. Now, all right, we've got some graphs on this one here. So, which of the following graphs depicts the total cost of the raw materials for a period on there? Okay, so when I first of all look at this, before we even go up to the lines up at the top there, you always go to the axis. So they've all got the same axis on there. So dollars, so the amount and activity. Then you've got to say, next question is, where does it start? So you can see we've got some starting at the origin, some starting where the fixed cost line would be on here. And then that's where we'll have a look at the top bit on that now. So up to a given level of activity in each period, the purchase price per unit of a raw material is constant. Okay, so that's where we have the linear approach that is going to be straight. After that point, a lower price per unit applies. Oh, okay, so that's where we've got the first relevant range, then we go into the next relevant range where we're expecting it to drop. But both applies both to further units produced and also retrospectively to all units already being purchased. So this is all about variable costs on here for the raw materials. So straight away we can rule out that one on there. That it can't be that one because it's starting up here that with no activity, it's already going to be charging us for some amount on there. Now going on for the next part is, notice how it said after that point a lower price per unit applies. Well, that tells me we need to have a diagram with a little drop like that, because can you see how it goes from a price point there, and then after we go when we need to actually expand on here, so a lower price point applies from the units purchased. We actually have it for the different period on here, so it has to drop. So that's where it can't be that diagram, because it just carries on as if it's in the same relevant range. Now we've got to actually come to, well, which one is it going to be? Is it going to be the top one or the bottom one? So you've got to look at the gradient on there as to, look how steep the first gradient is, and then the next one is lower. But the actual top one on here, it's extrapolated at the it's got the gradient at the same rate on there, but it's the extrapolated point that is really key for us here. So if I use my mouse, look where that line would intersect on the axis. It's going to be going straight back down to 0, as if it was carrying on at the same variable rate. That the more activity we have is going to go up in price at the same amount. However, look at the gradient on the last one. That is inconsistent, and if we extrapolate that line, it's going to be hitting way up here. It's not going back down to 0. So for me, based on that, we need to take the one where, if it was to be extrapolated, that if we didn't have the first bit of that diagram and it was just this, that would go straight back down to 0, like we can see on there. So it has to be the first one for me. Right, oh, okay, next question. You've got to be getting these in the exam. These are the questions that make or break if you pass it. But which two of the following are benefits of budgeting? So if you ever get this in the exam, number 1, make sure you put down 2 answers, because if you only put 1, you don't get 1 mark, you get none. And secondly, don't make any silly mistakes not actually reading it properly. So which two of the following are benefits of budgeting on there? And we've got, it helps coordinate the activities of different departments. So I always ask myself for these questions, does that sound reasonable? And in that case, I think it does sound pretty reasonable for that. It fulfills legal reporting obligations. Well, this isn't, remember, budgeting isn't anything to do with IFRS or any of the standards. So it fulfills legal reporting obligations. It's not an obligation to do budgeting, so that isn't correct, or a benefit of it. It establishes a system of control. Well, yes, we have variances and costing on it, so that's looking pretty good. It is a starting point for strategic planning. Well, not necessarily. I mean, strategic planning for me is all about the board of directors thinking 3 to 5 years into the future. That's where it's going to be part of the actual, say, annual reports on there. The budgeting is mainly operational on a day-to-day basis of an organisation, and about the systems of controls that we've got to manage the cash flows, working capital management on there. So it helps to coordinate activities of different departments. I would say so, definitely yes on that. It's not relating to strategic planning as such, so I would definitely be going for a system of control. Lovely stuff. But just try and work it out. Just try and go, does that actually sound right to me on there? Yes or no? Okay, so again, let's have a look at question 10. Which of the above statements is/are true? So is it 1, 2 and 3, 2 only, or 1, 2 and 3 on there? So the following statements relate to the actual participation of junior management in setting budgets. So again, try and picture that, whichever workplace you're maybe working in, or from your experience, you've got a junior manager in there, you're setting a budget. How is a junior manager going to react to actually setting it? So we've got first one, it speeds up the setting of the budget. No, I mean, if you're a junior manager, picture it that you're starting in your career and you're a junior manager and you've been told to do a budget. You're going to take your time over it. You haven't got as much experience, so that isn't true. It increases the motivation of the junior managers on there. I would say so, because they'll be quite chuffed to be more involved with setting the budgets, more responsibility. So I think 2 is correct so far. It reduces the level of budget padding. So budget padding is all about you adding a bit more to a maybe cost centre or to the budget to pad it out so that it looks a lot more pleasing on there, and you've got more wiggle room, should we say. So in actual fact, I would say if I'm junior management in there, I'm actually going to pad it out more than someone who is experienced, who's done it before, because I want more of a buffer. And if I get something wrong, then it's only going to be better for it, because we're going to have a favourable variance. So it's not going to reduce the level of budget padding, it's actually going to increase it. So for me, it's going to be just simply 2 only on there, I would say, on that, and thankfully it is correct. Lovely stuff so far. Hope you're enjoying today's management accounting. Good fun on a Friday. But the next one we have on here, what is this one all about? What is the company's ROI, return on investment? So a company has capital employed of 200,000. It has a cost of capital of 12% per year, and its residual income is $36,000 on there. What is the return on return on investment for you? Right. So this is where you've got to be able to picture the different areas of the actual income statement and understand the different factors along with the formulas. So the return on investment is all about the operating profit before interest and tax, divided by the capital employed, and that's going to multiply by 100 on there, is going to give us the return on investment. However, the key thing here is the residual income is after any interest or percentage cost of capital cost. So what we actually have here is we've got the bottom line figure of residual income, but we need to add back the actual interest on the capital employed. So I'm going to have to pull out my trusty calculator on here. So we need to cancel all that. So we've got to take 200,000 now, multiply that by 0.12 equals. So we've got $24,000 of interest has already been applied to that residual income. So it's already been actually reduced. So what we need to do is actually add that back. So 24,000 plus 36,000 on there. So it's 60,000 for our actual operating profit now before any interest and tax. So what we need to do to that now is take the 60,000, divide it by the 200,000, be careful on your zeros, equals, and that is our return on investment. Now it's asking for a percentage, and these are always given unless it states in the question as a whole number. So we need to multiply that by 100, and that gives us 30. But let me just show you, if you'd have done it in the exam and actually put 0.3, you wouldn't have got the mark. You've got the right answer, but you need to multiply it by 100 to guarantee the mark on there. So let me just put it in on the screen. So we have got, there we go. There's our 30% on there. Got the keyboard right. So that's, again, 2 nice marks. 2 more marks on the way to passing your exam. And again, I'm always just conscious as to the time. We're coming up to half an hour in. Obviously, I'm trying to explain it to you, show the workings, go through it. But it is a time-pressured exam, this, and Section B tends to be the harder. And make sure you attempt all of the 100 marks as well. Right, which 2 of the following could have caused the variance? Which 2 of the following could have caused the variance? Oh, okay, so we've got to read the top bit first before we go down to any options. A company has calculated a $10,000 adverse direct material variance by subtracting its flex budget direct material costs from its actual direct material costs for the period. Right. If you ever get this kind of question in your examination, just take a step back. Just relax, there's lots of stuff there, but just remember what it's actually saying. So what it's actually saying is that the company's calculated a £10,000 adverse direct material variance. So in other words, we have, just quite simply putting it, we have used more direct material than we were expecting to. So if we've used up more direct material, whether that be units, costs, whatever it may be, how has that happened? And which 2 of the following could have caused that? So can you see how I've just reworded that to make my life more simple? So the units sold being greater than the budgeted, well, that's actually a favourable outcome on there because we've sold more than we budgeted, so it can't be that. An increase in direct material prices, would that have had an adverse effect? You bet it would on there. Definitely one of my answers without even reading the other two. An increase in raw material usage per unit, well, that means we've used more than we were expecting to, which again is adverse, but let's check the final one. Units produced being greater than budgeted. Again, that's a favourable outcome for the business, that we've produced more than we actually expected, so it has to be the third one on there. Lovely stuff, another nice 2 marks in the bank. So what have we got here? We've got, okay, we're going to need the calculator on this. So this one we're going to have to be using, and let's just get rid of that on there. So we've got, what is the fixed budget profit for the period on here? So we've got 110, 130, 137 or 103. And we've got to say that the company has recorded the following variances for the period. Standard profit on actual sales for the period was $120,000. What was the fixed budget profit for the period? Right, okay. So it's like, it's trying to picture it for these kind of questions to say that what we're given already is the actual sales, so the standard profit on actual sales. So $120,000 is what actually happened, and what they're trying to say to us is, based on the fixed budget profit for the period, what would be the profit for the period? So what that's saying there is the pricing, the costing can't change. The only variable factor that could change is the actual volume on there, because the price and the costing are all the same. So I'm thinking straight away, we're not going to have to amend anything for the price or the cost variance up there. It's all about the volume. So now we've got to make the decision as to say, which way does it go? And what it's saying there is that based on the actual figures, we had $10,000 worth, we are $10,000 worse off because, let me highlight it for you, we are in an adverse position. So take that on the flip side to say, well, based on the budget then, we should be expecting profit of $130,000. Now what I mean by that is that the budget would have said a profit of $130,000 for the fixed budget, but what actually happened was we actually sold in volume less than we were expecting by 10,000, so that's where we get to the 120,000. So you just got to work it backwards. But for the calculations, it's just 120,000 plus the 10 equals 130 would definitely be my answer on there, because it's a fixed budget where the actual price and costing will not change for you. Right, which of the following are suitable measures of performance at strategic level? So strategic, for your notes, is everything on the lines of, say, the board of directors, long-term thinking, 3 to 5 years, taking into account the external stakeholders like shareholders on there. So what would they actually be suitable measures for performance on that? Well, return on investment, I would definitely say, as a long-term strategic level thinking, return on investment is definitely going to be key. You think about multinational companies, are they going to be interested in their market share at a strategic level in the future? You bet their bottom line it is, because investors are worried about their actual returns. But from a strategic level point of view, is the number of customer complaints really going to be a high priority? Probably not. So it's going to be, for me, a 1 and 2. The flip side to get into your notes for that is that strategic level is all about 3 to 5 years into the future, forward thinking. Whereas if you got a question in your exam about operational, that's all about the day-to-day running of the business. So you could get a question on that, just for your notes on there that could help you out. Oh, nice. Another little short question. Which two of the following are feasible values for the correlation coefficient? So you've got plus 1.4, plus 1.0404, 0 or minus 0.94. Well, this is going to show up a student who's been through the core text, understands the correlation coefficient, that a correlation coefficient can only have values in the range of -1 to 1. And this is where, if you have a look at some of the graphs, do a bit of research after this video, that you'd have your axis like that. Positive correlation, you'd have all your actual dots and markings on there from your graph going in a positive correlated way. Negative would be going downwards, and naught goes straight flat line across. So the two that are feasible have to be between -1 and 1, and they are 0 and -0.94. Easy marks, do not throw them away. Right, what have we got here then? So which companies' operating costs are 60% variable, 40% fixed? Which of the following variances values would change if a company switched from standard marginal costing to standard absorption costing on there? So what have we got on here? We've got direct material efficiency variance, variable overhead efficiency variance, sales volume variance, and fixed overhead expenditure variance. So this is all about the actual, and the key word to get down in your notes, from the following variances, it's all about the value on here. And standard marginal costing values it at the actual contribution. Okay, so standard contribution is for you to get down. So that's the sales price less all the variable costs gets you your contribution. Whereas standard absorption costing is all based on the actual standard profit on there. And we already had a little look earlier that from a previous question, if you want to refer back to it, remember we had those 2,000 units and we had to reduce the profit down by that 9,000. And this is where the changes in actual volume affect the variances and how we actually value both of the two. So efficiency affects both of them. It can't be efficiency on there. They affect both of them. And we already factor in the fixed overhead expenditure within both of them. So it's actually just looking at the variable of volume, how it changes. It would affect the value in different ways because marginal costing and absorption costing are different measures, because we absorb the costs through absorption through profit, the bottom line profit, whereas marginal costing is all about that contribution further up in the actual sort of pro formas that you'll see within your core text. So this one for me has to be based on volume, nothing to do with the rest on there. Right, what have we got here? Right, we've got something to do with capacity. So what is the budgeted total production cost if the company operates a 85% capacity? So we've got capacity up here of 60% gives us a total production cost of 11,280, and 100% capacity 15,120. ABC has a manufacturing capacity of 10,000 units. The flexed production cost budget of the company is as follows on there. Okay, so we are going to have to let me pull it up on here for you. Right, so even just by the little layout on there, things stand out for me. First thing is we're going to be having to use the high-low technique to be working out the actual variable cost. And the other trigger for me was the total production cost on there. So when I read that, I'm going, hang on, that's got variable costs in it and fixed costs in it. We need to work out the fixed cost and then apply it to an 85% capacity. So we've got to work it through the high-low technique. We've got to take the high figure, 120, sorry, so 15,120, minus the low figure, so 11,280 equals, so 3,840 is our numerator, so top of the fraction, and then the actual denominator, the lower part, is going to be based on capacity. So I've just got to remember this because it's a noddy calculator on here. So capacity at 100% is going to be 10,000 units. Capacity at 60% is going to be 6,000 units. So just remember 3840. I've got to do it on the calculations. 3840. Okay. So 4,000 units, 4,000 capacity is going to be at the bottom. So 3840 divided by 4,000 equals, so that there, for each unit, we have a variable cost, okay, on there of 96. not 96 cents for you on there. Oh, hang on, let's pull that back up. 96 cents on there. So what we need to work out now is actually for that is, well, what is the actual fixed cost based on this? So we've got two options, but usually I would always go for the larger figure on there. So would you not agree that for 96 cents multiplied by, me trying to multitask, the 10,000 units at full capacity gives me a total variable cost of $9,600 on there. But the total production cost is $15,120. So if I take minus 15,120, that gives me a fixed cost of $5,520 on there. So that's the fixed cost element. But we're asked, what is the budgeted total cost, total production cost, if we operate a 85% capacity now? So we've got to think, right, so 85% capacity means 8,500 units. So what we do is, so remember, 5,520. So 8,500 on there, multiplied by 0.96 equals plus, so 5,520. So the 8,160 is our variable cost element. The 5,520 is our fixed cost element. So by plussing that on there now, we get 13,680, which is going to be our total production cost at 85% capacity. And that looks reasonable to me because 13,680 is between 60% and 100%. So 13,680 is going to be on there, and then spot on, got the 2 out of 2, as we can work it through on here now. Lovely stuff, flying through it. But look at the time, it just goes so quickly, doesn't it? Right, use it. So what have we got here? What is the internal rate of return, the IRR of the project? Okay, well, using an interest rate of 10% per year, the NPV of the project has been correctly calculated as $50, okay? If the interest rate is increased by 1%, so going up from 10 to 11 to 12, okay, the NPV of the project falls by $20. Right, so this is really key for your notes on here, that to calculate the IRR, what we need is we need a value, an actual interest rate where we have a positive NPV, and then we also have an interest rate where we have a negative NPV. So just walk and talk it through to yourself that if I have a interest rate of 10%, my NPV is $50. If I have an interest rate of 11%, my NPV is $30. If I have an if I have an interest rate of 12%, my NPV drops from $30 to $10, so that's at 12%. But then if I increase that from 12 to 13%, my NPV then goes to minus 10. So it's between 12 and 13. It's going at a linear rate on there. So that must mean that at 12.5%, we have an NPV of 0. IRR is what is calculated at NPV of 0, and that in this case is 12.5% for us on there, which is, you know, nice and easy for us on there. We can live with that. Right, what have we got here now then? So, oh gosh, this looks a bit more complicated than the last one. So we've got on here, after the, and I'm just going straight to the requirement, so after the reappointment of service cost centres has been carried out, what is the total overhead for production cost centre P? Okay, right. So we've got on here that, I'm just trying to follow it through, percentage of service cost centre X to P. Oh, okay, so you've got the cost centres up here, 46, 30,000. A factory consists of two production cost centres, P and Q, and two service cost centres X and Y. Okay, so the cost centres are X and Y, production cost centres P and Q. The total allocated and apportioned overhead for each are as follows. Okay, so what it's saying there is before we've got to reapportion them based on the percentages that were given below. So it's saying that we're going to start off at 95,000 for P, adjust based on these factors down here. So we're going to have to adjust for the 50, the 30, and also the 10, because that 10 there is going to affect the percentage of cost centre to Y. Right, okay. So we've just got to go through it bit by bit on the calculator on there. Oh, hang on, there's a bit more. The reapportionment of the cost centre cost to other cost centres fully reflects the above proportions on there. It's been estimated that each service cost does work for other cost centres. Oh, okay, that's why. So they overlap with one another, and hence this is why we're actually having to percentage and change it on there. So let's have a look then. We're going to have to get the calculator out for this on here, and we'll just work it through bit by bit on here. So I think because we've got the proportion to Y, to the cost centre Y, we'll work on this one first without me losing the calculator. First of all, so this is going to be added and apportioned onto the P cost centre now. So starting off at 95 on there, the first adjustment that we're going to have is this is 30% on here for the apportioning of it. And this has got to be based on that 30,000 up there. So let's do that first of all. So without me losing the calculator, 30,000 multiplied by 0.3, because that's 30% on there. So the first figure that from the apportioning, just based on P, because this is the one we're looking at, in terms of cost centre Y, that's the first 30%, so it's going to be 95,000 plus 9,000 straight away. We've then also got that the percentage of the service cost centre to Y, and this is going to affect X on here, we've also got this 10% to take into account on it. So it's almost as if it's reapportioning the X's and Y's, but we still have to take it into account. So what we have here is, just to break it down for you, is that 10% percentage of service costs Y to X is at 10%. So what it's saying there is the 30,000, because we're still working with Y, multiply that by the 10%, so this is the rate that we're given here to apportion it by, is 3,000. But that now converts as if it was, from a P perspective, a service cost. So this has now been reallocated to a service cost for X. And because we're working on P as a result of this, we need 50% of that. So from the new reallocation of the 3,000, we would then multiply that by 50%, and that gives us 1,500 on there. So we've got the 95,000 plus the 9,000. So remember, we start off at 95 plus the 9 plus the 1.5, and then we've got the final. Let me pull up the calculator on here. The final adjustment, or reapportioning, whatever word you want to call it on there, for cost centre X for us. So cost centre X, we've got 46,000. So 46,000 multiplied by 50% equals 23,000 on there for the final one for cost centre X in regards to P. So we've just got to add them all together now. So let's do it as if I was you and as if I had a rock and roll calculator. So you got the 95,000 where we started at, and we'll just go through it exactly like we did. So we've got to plus the 9,000 on there, plus that 1.5 for the X factor as well, and then finally plussing the final one, which was apportioning the 46,000, so plus 23,000. Fingers crossed, that now comes to a figure at the bottom, 128,500. Rock and roll. That's going to be my answer for it. But just try and work it through logically, follow it through from the service cost centres and how we have to apportion it. But maybe you actually got a bit stuck on this question. You could quite easily flag it at the bottom, come back to it later on. As you've already seen as we've been going through, there are easier questions to pick up on for marks than that one. So maybe put that down for some of your exam technique, because that took us quite a long time to actually go through on there. But moving swiftly on now. So what have we got here? So, oh right, EOQ. So a prepared management accounting student will see that straight away, and we'll see that we have the economic order quantity. So a company always determines its order quantity for a raw material by using the economic order quantity. And for anyone who's maybe new to management accounting, that's all about looking at the most effective way how we order in goods, materials, raw materials, whatever it may be, to minimise the cost for the business on there. It's a model. You can have a look at it through your actual core text. And as you can see on here, we were asked what would be the effects on the EOQ and the total annual holding cost of a decrease in the cost of ordering a batch of raw material. So the EOQ and the annual holding costs, would it be higher or lower on there? So let's just read that back. What would be the effects on the EOQ and the total annual holding costs of a decrease in the cost of ordering a batch of raw material? So in other words, the cost has gone down. Now, the key thing to get through here is, for your notes, is so many students wouldn't use it to help them to their advantage, but we shall. If you head down to the references on here, and I'll just move it over so you can still see me on there, is we're going to go down to the formula sheet. These are what you're given in the exam, and as you can see on the screen now, there is the EOQ there, the actual formula that it is referring to. Now, so we've got the number 2 on there, that is consistent. The CO is the actual cost per order. The D on there is the actual demand, or the annual demand for you. And the CH is referring to the cost of holding 1 unit in inventory on there. So the cost of holding 1 unit of inventory and the cost per order. And so we're actually told on here that we actually had the decrease in the cost of ordering a new batch of raw materials. So let's pull it back up again. So that if the cost of buying raw materials is actually going down, well, that is going to have a negative. That's going to have a, I don't want to say negative, it's going to have a reducing factor on that actual formula, because the cost of the order from the numerator perspective is going to go down. So hence that is going to give us a lower figure overall on there. And in terms of the actual annual holding costs, that's going to actually bring down the annual holding cost as well. So it's going to reduce that number in the denominator going down on top of it. But that is where it's going to, again, reduce the EOQ figure down, because we've actually got the cost down as well. That is what we're looking for, and that is what the actual formula on there and the model is designed to do, to get the cost down as low as possible. So it's going to bring the EOQ down lower and the annual holding cost lower as a result on there. Marvellous. So let's keep on going on there through. Again, use these other tools to your advantage. If some of those other formulas in that reference looked a bit iffy to you, have a look back at those on there. Now, next one. Okay, so what was the total value of the 2,000 units transferred to the finished goods warehouse last month on there? So what was the total value of the 2 months transferred? Okay, so we've got a few sentences on here. Just try and picture what's going on. It's always the best thing on this kind of actual exam. So a company which operates a process costing system had work in progress at the start of last month of 300 units valued at $1,710, which was 60% complete in respect to all of the costs. Last month, a total of 2,000 units were completed and transferred to the finished goods warehouse. The cost per equivalent unit for costs arising last month was $10. The company uses a first in, first out method of cost allocation. So what you've got to think about there is you've got 300 units at the start of the last period as work in progress. They're nearly done. They're 60% complete. So they've got 40% to go. And then we actually need to get through 2,000 units. So we need another 1,700 units on there to actually go through as a result. So we've got to have, let's pull it up on here. So wouldn't you agree that we've got a current balance of 1,710 for the 60%. So what we need to work out is what is the actual cost for the remaining 40% on there. So what we need to say is that we've got 300 units that are the work in progress that still have 40% to actually be completed. So there's my 0.4. And then the total cost arising per unit in that period was 10. So I would multiply that by 10, and then that would give me the total cost for the remaining 40%. So I'm trying to be crystal clear here now so it comes across perfect to you, in order to complete those goods. So the 1,710 is for the 60%. The 1,200 is for the remaining 40% to complete those work in progress goods that they're fit for purpose and they can be sold. And then we've still got 1,700 units now that need to be completed and sold at a cost. And we know they are £10 per unit on there. So that's where we've got 17,000. So what we need to take there is, so we'll take the $17,000 for the remaining 1,700 units, okay, plus on top of that, 1,200 for the 40%, plus 1,710 for the 60%, and that will give us the total value for 2,000 units to become all completed, fit for purpose, finished goods. So my answer is 19,910. Spot on. Lovely stuff. Right, what have we got here? Moving swiftly on. We're already coming up to an hour in. Stay with me. Stay to the end. Keep making notes. I'm doing my best. What is the budgeted net profit for the last period? The company uses marginal costing. The following variances occurred in the last period when the actual net profit was 40,000. What was the budget? It's another one of these questions where it's given us the net profit figure of 40,000 and it's asking us to work back to say what was the actual budgeted profit before or after the results of the year. So we're going to have to get the calculator up again on here. So what we're saying here is that we've got 40,000 and the budget, hang on, let's work this through. The budget, it would be then that it would be expecting a better outcome. So take materials, for example. The budget net profit, would you not agree, would be in a $900 better position because the actual net profit is $900 worse off on there. So to kick us off, it's just going to be the opposite of all of these, I would say, on here. So let's just work it through that we've got the 40,000. The budgeted profit would be in a more better position for materials. So you've got to add that back. The labour, which we did better on, how it really turned out, we had a worst case scenario, so we minus 1,000 from that. And then I'm just going to keep going. The overheads, we thought were in a better position, so plus 700, minus 500, and then minus 900 on there. So I've got a figure working backwards, that now the budgeted net profit was 39,200 based on these changes, whereas the actual net profit was 40,000. So thankfully we've got an answer there. That is what we'll be having on there. But just try and walk and talk it through to yourself. Keep it logical as well on there. Identify whether, see look, these are a bit more easier ones on here. These are the easy marks not to throw away. So like I said, flag the questions if they're a bit difficult. Identify whether each of the following statements about uses of big data analytics in organizations is true or false. So big data analytics is all about taking large quantities of actual data that a business may have and then quantifying that so that we can get some output so we can make better decisions for it. And identify whether each of the following statements about the use of big data analytics in organizations is true or false. So taking data, could it help better understand customer behavior and preferences? Of course it could. If we're analyzing that data effectively, that could definitely do that. It helps to analyze the efficiency of business processes in real time. Most definitely. It takes all that data, as we said, and looks at working out desired outcomes and where we can be more efficient and effective. Under which of the following labour remuneration methods will direct labour cost always be a variable cost? Piece rate, group bonus, day rate, differential piece rate. Well, it's not day rate on there, first of all, because that is not variable. That's the fixed amount that you get paid regardless. A group bonus scheme, again, that's not guaranteed. That's more sporadic. It might happen this year. It might not happen for the next 2 years. So it's either piece rate or differential piece rate. And this is one of those little areas of the syllabus where differential piece rate is all about where we actually select a small little sample and we do it on that basis and we run tests associated with it, with whatever we're actually making from a labour perspective. Whereas piece rate is the bottom line of if I turn up to work for a full day and I make 20 units and they pay me $5 a unit, well, I make $100 for the day. It is variable in the sense of piece by piece, the more I make, the more units I make, the more money I make. And it's on a linear process, so it has to be piece rate because that is variable. Right, oh my word, you'd be thinking of this. We've got a lot of stuff on here. Right, which of the following combinations of profit and losses for the 2 months is consistent with the above data? So we've got on here absorption costing, marginal costing, profit and losses for months 1 and months 2. Okay, so just try and break it down that you've got absorption costing in month 1 being a negative or a positive or a negative or a positive, and then going into being a positive in the second month versus the flip side, which should be on here for the marginal costing. Remember, they're measured at different rates, contribution versus total versus profit. So let's see what we've got in terms of information. So we've got on here, a company manufactures and sells a single product in 2 consecutive months and the following levels of production and sales. Right, okay. The opening inventory, all right, hang on, let's just go through it. We've got sales production, month 1, month 2. Okay, so we sell 3,800, produce 900, so the inventory goes up. Right, so the opening inventory in month 1 was 400 units. Okay, I'm just thinking we're going to have to use the calculator on this, aren't we? Profits and losses have been calculated for each month using both absorption and marginal costing. Right, let's get the calculator out on this. So we are on now. Let's have a look. So we've got to say, let's cancel that. Let's just work it through logically as we go through this, okay? So we've got 3,800 for the actual sales and we've produced 3,900. So would you not agree that if we started off with an opening inventory of 400 there, so 400, we then produced 3,900, we then sold 3,800, so would you not agree that the inventory has gone up from 400 to 500 within the actual first month on there. So that's what we have for the first month, and that is where we're actually going to have now the absorption costing is based on the more inventory that you have, the higher the profit is going to be. So first of all, it can't be a negative for the first one on there, for the minus 400. It has to be either the 200 or the 200, because it's one of the factors that, because of the way it absorbs the cost, the more inventory that you have, if inventory goes up, absorption costings profit goes up more as a result. But now, taking that 500, and this is where the flip side is going to happen, is that we're going to have now the actual 4,400. So we'll just work it through as if it was on here. So we've got the 4,400. Let's make sure we do it on here. So plus 4,400 equals minus 4,200 equals 700 on there. So we've sold, hang on, that can't be right, can it? We've sold more than we produced. No, so hang on, I've done that the wrong way round, haven't I? Good grief. Right, 500 produced plus 4,200 less 4,400 equals 300. That's better, because the inventory has gone down from 500 to 300 on there as a result. I'm just going to have some water on there because I'm a bit parched. So that's saying to me that the marginal costing will then be factored into it. So I know it's going to be, the absorption costing is going to be $200 on here, but then is the marginal costing going from the second month going to be, can you see on here how absorption costing is at 3.2? Is marginal costing going to go up, or is marginal costing going to go down? Now, because we've got less inventory on that, that means that marginal costing will be going up because we're not absorbing as many of the costs. So I'm going to say it is that one on there. Ho ho, 2 out of 2. But it's just thinking it through logically as to how we factor in all of those areas on there, along with understanding that the more inventory, the key thing to get down in your notes is, the more inventory that you have in actual, at the end of the period, if it's gone up, absorption costing profit goes up as well on there. So what have we got down here now for 26? So we've got the following statements relate to the advantages of linear regression analysis has over the high-low method on there. Okay, so we have got reliability of the analysis can be statistically tested. We've also got on here which of the actual following ones. Okay, so we've got, okay, let's go down to the options. Which of the above statements is actually true? Okay, so we've got 1, 2 and 3, 1 only, 2 or 3 and 2 and 3 only on there. Okay, so let's just go through it. The following statements relate to the advantages over linear regression analysis versus the high-low method on there. So the reliability of the analysis can be statistically tested. It takes into account all of the data, and it assumes that a linear cost behavior. Which of the following statements is true? Versus a linear regression analysis over a high-low method. So the high-low method assumes a linear cost behavior on there, and the actual regression analysis is looking to predict the future value based on the variables. So linear regression analysis is all about the reliability of the analysis can be statistically tested. So I agree with that. It's a more reliable method using linear regression analysis versus the high-low method. It takes into account all the data. Yeah, that does. The high-low method doesn't. Remember when we did it on a previous question? Which one was it? It was the 10,000 units and the 6,000 units to get the 85% on it. That's where it didn't actually take into account the potential capacity lower on. So for me, it has to be just 1 and 2 here, if it was me, on there. Lovely stuff. I'm just conscious on time on this. We've only got 49 minutes left. I'm losing my voice. Right. Next one. A company. Right. Question, James. Focus in. This is like you in the exam. You lose focus on it. That's it. What was the percentage degree of completion of the closing work in progress? Right. So I go straight to work in progress. Okay, this is where you really got to read the question properly. It's asking for you there, in a nutshell, the percentage degree of completion of that work in progress. So in terms of value, where are we at in terms of it? So the percentage degree of completion, you don't really have to, nothing about the costs arising on there, that's to just sort of balance it down. So let's pull it up on here, let's cancel that for you on there. So you've got to say, from that $480,000 for the 10,000 units, 408, okay, divide it by the 10,000 units. This is going to give us the cost. Yes, this is because it's got all elements of cost. That is $48, the cost of a finished unit on there, versus a work in progress unit is not fully complete. So 144,000 divided by 4,000 units, which you've got on there, gives us, there we go, $36. So what it's saying to us there is the work in progress units, those 4,000, are currently valued at $36 based on how much they've actually completed. But we know that a fully finished one is $48. So we can actually work out the actual percentage degree of completion now. That if we take the $36, divide it by the 48, 0.75, times that by 100, and lo and behold, that's where we're going to get the 75% that we're looking for, that those work in progress units are 75% complete compared to the finished units on there. Whew, get where we're coming from now. Good stuff. Isn't it amazing? We're just going through it and like, gosh. Right, next one. How many have we got left? 28. Okay. So, test progress details. Yes, got a few more to go on there. Okay. So, which of the following would not be expected to appear in an organisation's mission statement? So, a mission statement is sort of what they like to talk about themselves, what they strive for, what their actual values are, what their meaning is, what their purpose is. So, quantified short-term targets the organisation seeks to achieve. Well, I would not expect that to be in McDonald's or Aston Martin's or Tesco's mission statement, but let's check out the others. The organisation's major stakeholders, I'd probably expect those to be in there. The products or services offered by the organisation. Yes, I would say so. Yeah, if you listen to Apple's mission statement, they talk about their phones and computers. The organisation's values and beliefs. Well, that's definitely in there. So the first one is definitely not going to be in the mission statement. I can tell you now. Right, what is this one? This is going to need some calculations. I can tell with the dollar on it. Okay, if an employee produces 200 units in 8 hours on a particular day, what is the employee's gross pay for that day? So let's pull it up on here then. So we've got, I need the calculator definitely on this. So an organisation operates a piecework. Oh, okay, so we saw that earlier on in the test. They've tested it twice now. System of remuneration, but also guarantees its employees 80% of a time-based rate of pay, which is based on $20 per hour for an 8-hour working day. So in simple terms, what that is saying is that if you work an 8-hour day at $20, then they will guarantee to pay you 80% of that, even if you don't make enough units. So at the end of the day, this person is guaranteed to make $128 for the day. However, they've produced 200 units in 8 hours, and it's 3 minutes is the standard time allowed per unit of output, and this piecework is paid at a rate of £18 per unit on there. $18 per unit on there. So, right, let's have a look on that one then. So, what have we got on here? We've got 20. Just trying to read. 3 minutes is the standard time allowed on there. Piecework is paid at $18 per standard hour. Right. $200. Right. So he's made 200 units. I'm just trying to get my head around this. So what I worked out there is the 200 units multiplied by it. For those 200 units, it takes 3 minutes to actually make them. So what it's saying there is, if you've got 60 minutes, 8 hours. 8 hours. Oh, no, I've got it. I've got it. I'm thinking in a different sense. So, it's based on, piecework is all about the number of units they produce. So, what we're saying here is that ordinarily, gosh, you have to read these things carefully. Ordinarily, it's 200 units in 8 hours, but 200 units is actually in, if you divide that by 60, that would be in 10 hours on there. So what they're saying, if an employee produces 200 units in 8 hours, that's it. That's it, you see. So if you were to make 200 units based on the usual piecework on here, then that would be 600 minutes, which is the equivalent to 10 hours for it. But he's made it in 8 hours for you on there. But because it's piecework, piecework is paid. Because he has made 200 units worth in 10 hours, he now gets it at $18 on there. So it is based at, because he is more this person is more effective. Gosh, this is confusing now. He is more effective at making the products, so he is going to get $180 for the day, not the $128, which is the guarantee for it on there. So based on the piecework and the standard rate that he's managed to make 200 units in 8 hours on that particular day, which those 200 units would have taken 10 hours to make. So because it's piecework, he's more effective. He's going to get $180 for it on there. Whew, gosh, you really have to think these through for it. Good grief. Sorry if that confused you, everyone. But in a nutshell, they can make the 200 units more effectively than the other employees can on there. So the 200 units in 8 hours, you would actually get 10 hours worth of pay for it. That is where it's coming from. Good grief, really. I don't even want to know what my hair looks like. I hope your hair's okay doing this. A company uses, by how much was the total overhead under or over absorbed for the period? So we've got under absorbed, over, okay, so we're going to have to work something through here. So a company uses an overhead absorption rate of £3.50 per machine hour based on 32,000 budgeted hours for the period. During the same period, the actual total overhead expenditure amounted to 108,875 and 30,000 machine hours were recorded on actual production. Right, so the first clue here is the $3.50 per machine hour. That's the key thing on there. So we've got to be taking the 30,000 on what actually happened, because then that's where we're going to work out if we over or under absorbed. So the 30,000 multiplied by $3.50 equals 105,000. That's what we have down based on the machine rate hour for the overhead absorption rate. So minus that to 108,875 equals, what we're saying here is that we have under absorbed, because what we should have absorbed it at was 108,875. We've under absorbed at 105,000. So under absorbed 3,875. So just follow through the question, read it through carefully. I know you're probably feeling the effects like I am on this, but just keep going through it. And I'm just conscious on time as well. I've got to stop explaining as much. Which two of the following statements relating to management accounting information is true? So we've got two of the following statements relating to management accounting is true. So it is produced for parties external of the organisation. That isn't true. No strict rules govern the way that the information is presented. That is true. There are no rules on there. There is usually a legal requirement for the information to be produced. No, there isn't. It may be presented in monetary or non-monetary items. It's those two, definitely on there. There's no legal requirements and they're not used for external parties. It's all internal for you on there. In a pie chart representing the proportion of the sales made in each market, what would be the angle of the section representing market 3? So the total for the pie is $300,000. Market 3 is 51,000. I can tell you the mistake that people will make on this straight away. So we've got to work out the proportion of this. So you could do 51,000 divided by 300,000 equals, so 0.17. Now you'd be thinking to yourself, oh, 17 degrees. Surely that's right, James. Bang on, easy 2 marks. Remember, a pie is a circle. And how many degrees go round in a circle? A bit like with the inventory days or trade receivable days, we have to multiply by 365 for the number of days. Well, for this, we have to multiply by 360, and that is going to give us 61 degrees on there. So make sure you get that down in your notes for this. The number of daily complaints to a local government office has a mean of 12 and a standard deviation of 3 complaints. What is the coefficient of variation as a percentage? Well, we've only got 2 numbers on here, and you've got 2 ways of going about it. And I can tell you now, you've got 50-50 chance, but it is the standard deviation on there, and we need to get that on a basis compared to the mean. So that is where we're now going to have that, and it's at 25%. But notice as well, if we were to put in 0.25, we wouldn't get the marks, but we'll put it in as, excuse me, 25. So we definitely do get the marks on there. Right, what is the economic order quantity for inventory item to the nearest whole unit? Right, so you've got the purchase price of an inventory item of $25 per unit. In each of the 3-month period, the usage of the item is 20,000 units. The annual holding costs associated with one unit equate to 6% of the purchase price. The cost of placing an order for the item is $20 on there. Right, got to be careful on time. We've already gone over. Right, we've got on here the economic order quantity on there. So we've got to be working this out based on that formula for it. I've already talked about it beforehand, so I'm just going to take that off for you on there. So let me pull up my calculator. I'm going to have to plug this in. So we're going to have to do this on the numerator for us on here. So we've got to take the actual cost per unit. So we've got to take the 2 from the actual formula, multiplying that by the actual 20 that we saw. And this is for the numerator up at the top. We've then got the actual number of units on there. So we've got the 80,000 equals to 3.2 million is going to be your numerator up at the top, okay? Then we've got the denominator where we've got to take our actual purchase price for it. So you've got the $25 for the purchase price and then multiplying it by the actual rates. The annual holding cost for 1 unit equates to 6%. Multiply it by 6% on there. Gives us our 1.5. But what we've got to do now is, remember, we've got to also square root that. So we've got to take the 3.2 million divided by 1.5. I have no idea if we got this right, to be honest. Right, okay, so that gives us 1.224 on there. 1.224? No, I'm not. See, that just doesn't look right, does it? Right, we'll have to flag it. We'll have to come back. It's one of those things. Right, I've put the flag on. We can come back to it. If we've got time at the end, it's one of those things. I want to have time to go through the others. What's this? The results of the chemistry examination are normally distributed with a mean score of 56 and a standard deviation of 12. What is the percentage probability that a student will score more than 80? Well, we need to look at what is known as a Z-score on this, and that looks at the value relationship to the actual mean, and we've also, because it's looking at a lot of actual marks, we've got to look at the distribution on this. So what we're going to have to pull up on here is, again, the calculator. I'm going to do my best. 80 minus the 56. Okay, so that's the score that we want to get, minus the mean. And then we have to work that as a proportion. So get the equal to it, divided by 2. And so this is one of our measures as to where we're going to have a look at it in terms of the actual distribution table now. Because remember, we've got all these different scores, and we need to look at the probability of actually getting over 80. So we've got 2 on there, and this is where I need to pull it up on the reference, where we need to work out the distribution on this. So the distribution, because we haven't got any other factors for the normal distribution up at the top, no other variables, our factor based on the score that we're looking for is 2. So we need to take it based on no other data at 0. So 0.4772 is our figure for the distribution data given. Now what we need to do there then is saying that from that, notice on here for the distribution, it doesn't go any higher than 0.5. So that's what we need to base it on, that from a probability perspective of getting over 80 on here. So again, pull up your calculator on here, that we have 0.5 minus our 0.4772 equals, that is our percentage as to the probability. Oh, remember, it's got to be a whole number, so multiply it by 100, and that gives us 2.28% on there. Lovely stuff. Section A done. We're a bit over on time, but it's all right. It's one of those things that we can claw some back in the next section. We've got one question flagged. I'm just trying my best to help you out on there. So stick with me. Let's start to have a look through this on here. So we've been given, and before we actually get going, I always say in my videos, have a little sip of water. Get yourself deep breath, keep yourself going. We've got half an hour. You don't want to be making silly mistakes as you go through this on here. So, straight down to task 1. In order to determine whether a computerized tracking system should be introduced, indicate whether each of the following is relevant or irrelevant cost to a net present value evaluation. So an NPV is for the project. If it's positive, we should go through it. If it's negative, we shouldn't. And you have to allocate the cash flows, positive and negative. If it relates to the actual project, you should actually make it relevant. If it doesn't, then it is irrelevant. So we've got to have a look back at these notes up here and work out, are these relevant or not? So the first one, the computerized tracking system. Well, I'm assuming if we're having a tracking system, The expected costs and benefits of the new computer tracking system are as follows. The system would cost 2.1 million to actually implement. Well, if you don't actually have the 2.1, it's not going to be available, is it? So that has to be relevant for you. Depreciation, this is just one of those things that make it in your notes. Depreciation is a notional amount on there. So it's not a physical cash flow that needs to be factored into an NPV calculation. So I know automatically that is irrelevant for us. Staff training costs of 425,000. Right, there's my figure. This is what you should do if you're a bit pushed for time in your exam. Pick out the figures, go straight to it. 75,000 has already been spent on staff training in order to evaluate the potential of the new system. Further staff training costs of 425,000 would be required in the first year if the new system is implemented. Right, so that is relevant. We have to incur those costs in order for the system to be effective and in how it actually is implemented. New staff total salary of 120,000 per annum. Okay, so there's the 120,000. 6 new staff members would be recruited to manage the new system at a total cost of 120,000 per annum. Well, if we don't have those staff members on board, how are they going to actually complete and actually run it effectively? So they are definitely relevant on there. Staff training costs of 75,000. That relates to that 75,000 up there, not down here. That's relating to maintenance contracts. But this 75,000 it's referring to has already been spent before the new system was actually implemented. So this is what is known as a sunk cost, that we can't do anything about it. It's irrelevant on here and should not be taken into account with this question on there. We shouldn't be factoring it into an NPV calculation. It's happened in the past. We then have finally interest costs of 150,000 per annum, which is up here. So interest on money borrowed to finance the project would cost $150,000 per annum. Now I know what you're thinking on that straight away, yeah, going, hang on James, surely if we borrowed money, we've got a cost, that will reduce the profit on there. However, this is where your financial management and knowledge that will link into other exams comes into it, that when you have a cost of capital figure of 10% there, that actually has the cost of borrowing embedded into that percentage figure, in the sense of if the company is more risky, it would mean a higher percentage that would be allocated to the company that they would need to be paying to allocate that interest. So it's already factored in within the 10%, so the interest cost on there is actually irrelevant for you. Right, what have we got down here? So we've got which, okay, all right, we'll go down to task 3. This one looks a bit more simple on here, so, oh, no, let's just do it 1, 2 and 3. Look, I'm like a proper student now, good grief. Calculate the following values if the computerized tracking system is actually implemented. So we've got incremental sales in year 1. So incremental sales is basically saying if we didn't have the tracking system, what would be the sales versus what would be the sales if we put the system into place. And the difference between the two is our incremental sales. So we're going to have to have a quick look for these up here. We're going to need a calculator. So the sales, we're told, had £10 million for last year. And if we go to where the sales are expected to rise to £11 million, or $11 million in year 1. So 11 million is the first one. But if the new system is not implemented, so if the new system is not implemented, sales would be expected to increase by 200,000 per annum. So last year it was 10 million, it's going to be a 200,000 increase. So the incremental sales is going to be, oh no, it's not that, James. It's going to be 11 million minus 10.2 equals 800,000 is going to be our incremental sales on there. Lovely stuff. Savings in vehicle running costs in year 1. Okay, so how much are we saving on the vehicle running costs? Where is the vehicle running costs? Here we go. Vehicle running costs. So despite increased sales, savings in vehicle running costs are expected as a result of the new system. these are estimated to be 1% of total sales. So remember, this is as if the actual system has been put into place. We know the sales are going to be $11 million. So 11 million multiplied by 0.01 equals 110,000 on there for it. So you got 110,000 is your savings for the vehicle running in year 1. Now we've got the present value of the maintenance cost over the life of the contract to the nearest $1,000. Right, so maintenance cost over the life of the actual... Okay, take out the maintenance contract. There we go. Okay, yeah. So Cabco would have to take out a maintenance contract for the new system at a cost of $75,000 per annum for 5 years. So you've got $75,000 being paid for 5 years, year on year. Now this is going to show up a prepared student for this exam, that when they see that, they think, hang on, we've got cash flows into the future, we need to bring those back to the present value, so that just like it said in the question, the trigger here is present value here. So we need to be actually using, again, some of the other references in here, and we need to be using, because it's future cash flows, we need to be using the annuity table. If we were discounting using MPV, we would be using the discount rate on here for the present value table, where if you multiply any of those figures by 0 point something, it's going to be reducing the value down. However, we need to be using these ones on here, as this is going to be looking at the future amount that we're going to be referring to. And you've got the number of periods down the side and the actual discount rate over on there. So the discount rate in this question was 10%. We know that these payments are going to be for 5 years. So again, pull up the annuity table on there, make sure we've got the right one. There's our 10%, here's our 5 years. So we need to be applying 3.791 to this question here. So you've got, it's basically simple on here that you then go back to your calculator and we go 3.791 multiplied by 75,000 equals 284,325 on there. So that is telling us how much those 5 years of $75,000 are worth as at today. And again, it's already to the nearest thousands of dollars. We haven't got any points on this. So remember, 284,325, 284,325. Marvellous. Right, how long have we got left? 21 minutes and 35 seconds. Let's keep going. So Cabco wishes to maximise the wealth of its shareholders. It's correctly calculated the following measures for the proposed computerised tracking system project. The internal rate of return is 14%. Return on average capital employed is 20%. The payback period is 4 years. Okay. Right. So which of the following is true? And we've got IRR, but it's all about, so this is all about maximising shareholder wealth on here. So in other words, getting a return on the actual project. So the payback period is 4 years, and they've put here the project is not worthwhile because the payback period is less than 5 years. Well, we're not actually given enough information on that, really. And it's false on there because, well, the payback period is 4 years. The project is not worthwhile because the payback period is less than 5 years. Well, that's false because the payback period is 4 years on there. So that doesn't make much sense to me from being worthwhile. Plus, we don't have as much information on it. The next one, look at the top. The project is not worthwhile because the IRR is less than the return on capital employed. Well, yes, that is true in the sense that the IRR is 14% and it is less than the return on capital employed. But if you're comparing the IRR to a return on capital employed, IRR is focused on a project, saying should we go through with it, yes or no, whereas return on capital employed is looking at the debt, the equity within the business, the money that's been pumped into it, and then the operating profit that we get back from it. So it's really comparing apples with oranges that it isn't really true on there at all, that yes, from a figure point of view it is, but not in an actual practical point of view. The project is worthwhile because the IRR is greater than the cost of capital. Now that is looking more promising and true on there, because we have an IRR of 14%, and at the IRR at 14%, that is where the NPV of the project is naught. Now, if you have a look in your core text how IRR is actually worked and shown diagrammatically, so on an axis, is that we interpolate the 2 points, and basically if you have a percentage less than the IRR, that will indicate a positive NPV, and hence will be maximising the wealth of shareholders, because if we can get that project at a lower cost of capital, it's going to give us a positive NPV return as a result. But let's just check the final one. The project is worthwhile because the IRR is a positive value. Well, the IRR is always going to be a positive value percentage-wise, because that is the cost that we're having to borrow the money at. If it was a negative percentage, then the bank who we'd be borrowing money from, or whoever party it would be paying us interest. So that is not true on there. So it's definitely that one for me. 2 out of 2. Lovely stuff. Right, what have we got on here? So we've got some figures on here. We've got one for the actual robots. We've got Castille Deco. Okay, all right. Okay, we've got a few bits on here. Let's have a look through this. So we're actually being asked to, or have we got some other ones on here? What's this? I'm conscious on time. 17 minutes. Okay, right. We've got return on capital employed, return on sales on here. These are the nice questions that you want to be getting. So let's race through these. So we've been given sales revenue, profit before interest and tax. Let's get the calculator up on here. So if I see return on capital employed, profit before interest and tax, divided by the capital employed, so profit before interest and tax, 48 million. Gosh, we're going to have to race through this now. If I make mistakes, I'm sorry, I'm doing my best. Divided by 192, 123. So that is the actual capital employed on there, multiplied by 100, equals 25%. First one in the bag on there. Okay, return on sales or operating profit margin, again, should be easy marks for you. Profit before interest and tax, so cancel that. 48 million, 123, 123, divided by the actual sales revenue, so 480, 123, 123, equals, multiplied by 100 again, gives us 10%. Lovely stuff. Now, asset turnover is all about looking at the revenue that we're generating based on the capital employed that we've had within the business. So the revenue we've generated of 480 million, 123, 123, divided by on there the capital employed, so how much we've actually put into the business, and we want this to be as high as possible, so 192 million. So that gives us 2.5 times on there. So that is where we want it as high as possible. But again, key formulas that you just need to know going into this exam. Average weight for a telephone repair to the nearest whole number. So I'm looking on here for repairs. So average number of telephones repaired, average number is returned for repair each year, 10,000. And we've got repair down here as well. Customer, customer, bills, customer. So the average number of telephones unrepaired at the end of each day was 804. Oh, okay, we need to work out the percentage based on that. How long they're actually waiting for. So again, calculator out. Nice and quick. We've got 804 divided by the 10,000 equals on there. And notice how it's on the basis of days. So that should be ringing out to you to say we've got to not multiply it by 100. It's got to be multiplied by 365. So we've got 29.346 days. Now, we have to round that up to the nearest whole number because the 0.346 is part of a day. So I know 15 minutes left. So that is going to be for me 30 days on there. Last 15. Let's try and get as much of this done, okay? Calculate the following statistics for Nicholson & Co. Percentage of customers lost per annum. So let's head back up on there to number of customers lost, and then we need to find the total number of customers, so 1.96. So number of customers lost was 117,600 divided by the average number of customers, 1.96. So that is going to give us a loss of 6% on there. Doesn't need to go to 2 decimal places. Sales attributable to new products. So sales, it's going to be going back up to the figures up here now. So we've got the new products, sales attributable, and that $8 million is part of the total sales revenue. So that's where we need to work out the proportion of it. So again, 8 million divided by, and again, if you got this in the exam, you'd be thinking, gosh, my prayers have been answered, James. These are not the worst questions to be asked. Multiply it by 100. So this is the proportion of the new sales to the total sales, and it is 1.66 recurring. So this is where we need it to 2 decimal places. Take the 3rd decimal place on there, which is a 6. It's above 5. So that means that we have to round up the 2nd decimal there to 7 as a result. Lovely stuff. Right, what have we got here? Task 3. The following explanation is about balanced scorecards. So a balanced scorecard measures performance from 4 perspectives: customer, innovation, learning, financial, and... I mean, this is where it just demonstrates, do you understand the core concepts that you've had a look through in the materials, where it's all relating to the internal business processes, the balanced scorecard. It's 4 different sections. It takes internal and external, and it looks at the processes to say, how can we get more productive and more effective in how we work? Or even just read it through logically. Do you think process flexibility or non-financial success really goes in the ballpark with customers, innovation, learning, and financial? Not for me. On there. So that's task 3. Oh, hang on, we've got one more. So the scorecard is balanced in that it requires managers to offset bad performance in one area, good performance in another. Not a chance. A manager should be looking to get more effective from all areas of the balanced scorecard. That's why we break it up, so it's easier to digest. Achieve on an equal number of KPIs in each perspective. Well, KPIs are more about the annual report, the board of directors, looking at the strategic actual key performance indicators, how the business is being shaped going forward. So it's not really about achieving the equal number of those. That's a different area for business. It's really about delivering performance in all 4 areas. That's why we have the balanced scorecard broken up into those 4 areas: customer, innovation, learning, financial, and the internal business process on there, with a few of those areas fitting into one. Marvellous. Right, that takes us through that one. We need to go back to the previous one now. We've got 11 minutes. Let's do it. It's getting exciting now. So we've got Castilda Co. manufactures toy robots on here. Task 1, straight to it. Which formula will, correctly calculate direct labour efficiency variance in cell B18 for you now, isn't it? Okay, so we've got B18. So let's head on to it. It's going to be up there in the first one, isn't it? Okay. Yes, right. B18. So we've got direct labour efficiency variances. Okay, so it's all about how effectively are they managing their time, and then it's going to be quantified into dollars. So you've got to go straight the way up to direct labour on here. So we've got 6 hours, and then we've got it at $8. And then you've got to be saying, right, what options have we actually got on here? So we can be taking, and we'll just work a few through on here. So B13 seems to be standing out a bit as to direct labour. So this is the actual sales revenue and variable costs. So the actual direct labour is 1.221 million on there. Well, we need to, because it's an efficiency variance, we need to be looking at the actual number of hours on there. That's the actual total cost. But we need to be basing it on the standard cost on there. So the B13, C9 multiplied by C4. So C9 is the production on there. Okay, multiplied by C4 by the direct labour. So that's looking at what we're actually C9, C4, C9, C4. Yeah, okay, so we've got the production on there. But it's not referring to the 150,000 hours. What we need to be looking at is 150,000 hours, the fly going in the way now, is based on actually what was going on there. In fact, I might come back to that one later on there, because you're going to have to look at that in time. We've got 9 minutes. Right, task 2. So this is all about the standard cost operating statement. We've got some complete blanks on here, and we've got to fill them in. Okay, so if you get any of these in your exam, and you're at push for time like I am, always go for, not the first, this is which most students will go for. They try and pick out this one on the side here. That won't work. To help yourself out. This one is the first one. Sales price variance. So in essence what it's saying there is, what did we sell versus what were we expecting to sell on there. So let's head back up to what we've got on here. So what did we actually sell? So the actual sales revenue was 3,066,880. What were we expecting to sell based on the standard selling price? So you take the standard selling price of 120, multiply that by what we actually sold, so 25,600 units, and that gives us $3,072,000. Okay, so straight away, I'll put my mouse on it. We are in a worse off position than we were expecting on there. So minus 3,066,880 equals 5120 adverse. We are worse off on that in terms of the actual sales price variance. So 5120 and adverse on there for me. Now, we've got to look at standard contribution on actual sales. Again, follow the titles that we know are actually there. We're just looking for one figure as a result. So standard contribution on actual sales. So let's go to it. You know that you take the sales price less the variable cost, gives you your standard contribution. And remember, this is on actual sales. So we're going to go to here. Standard contribution 28 multiplied by, I'm just trying to, actual sales 25,600. So when you're going through your calculations, try and be precise on it. 25,600 equals 716,800 is our figure there for the standard contribution. 16,800 is our figure from there. So what we're saying there is now that we've got the budgeted contribution at 700,000. We've got the standard contribution here on actual sales to be 716,800. So the actual difference that we're looking at now, because you can see here, that figure minus that figure gives us our total figure down here. So this figure in the middle is a balancing figure on there. But then you've got to say to yourself, well, hang on, are we in actually a better or worse situation? It's asking us favourable or adverse. We haven't even got the title on it yet on there. We'll come into that in a moment. But what we're saying here is we're just working it through logically. We budgeted for 700,000 contribution. What we actually got on actual sales based on contribution, 716,800. So again, even if you were guessing in the examination, we are in a more favourable position on there for it. Let's have a look then as to what this is referring to. And remember, it's all based on contribution, where the variables of selling price and costs are actually already accounted for. They're already fixed in there. The change that has happened in that getting that figure to be more favourable is that we've sold more quantity for it. So if you went back up to on here, can you see how we budgeted for 25,000 and we actually sold 25,600? that is where it actually comes from on there. That if we took, if I've just got, I think it's going to be on there, we're going to try it, 600 multiplied by the 28, I'm hoping it's, there you go, there's your 16,800 as to we've sold more than we budgeted for. The contribution, that is the reconciliation of the 16,800, but that is all based on volume variance for you on there. 4 minutes left. Right. Which of the following, task 3, which of the following two could explain their interrelationship? So interrelationship means, are they linked and are they true? So Castilla Co's management accountant thinks that the direct labour rate and the efficiency variances for month 1 could be interrelated. So let's have a quick look. Actual production was less than budgeted. Actual production, so production, actual was 26, budget was 25. Well, that's incorrect on there. Actual production was less. No, it was more. So it's not that first one on there. We've got a lower grade labour performed tasks less efficiently. Higher grade labour performed tasks more efficiently. So have a look at the labour efficiency rates on here. So direct labour efficiency variances, well, they were more efficient. They had 48,000 favourable on there. So that tells me that they are more efficient and actually producing tasks more effectively. A productivity bonus was paid to direct labour. So let's head back up there to direct labour. We've got 150,000 hours. So from that 150,000 hours, it's a case of they would be paying those at $8 per hour, which is 1.2 million. The actual cost was 1.221 million. So there was an increase of $21,000. So that would indicate to me that they did actually get paid a productivity bonus on top of it as well, which shows they are interrelated. So they were rewarded for being more efficient in what they did. Now, coming back to this formula on here. Now, the first one is it's not going to be relating to the actual B13, the total overall cost. We need to be basing it on the 150,000 hours so we have comparability for it. But then it's a case of which one is it? So if you took C9 multiplied by C4, so C9 26,000 by C4, which is the 48. So you've got 48 multiplied by the 26,000. That gives you 1.248 million on there for a figure. Now, that is then where we take the 150,000 multiplied by 8. So that is the total cost of the total standard cost for the production, what we were expecting to produce. But then we're going to have to multiply that by the 150,000 by the 8. So we've got the number of hours here that it actually took. This is where, from an efficiency point of view, we've gone on, that calculation was based on the 6 hours. This now calculation is based on the 150 hours. And that is the trigger as to efficiency and why we picked that one over the other. So 150,000 multiplied by 8 equals 1.2 million for us. So what we needed to do there was 1.248 minus the 1.2 gave us our 48,000 favourable, which is where that one up at the top is going to be correct. The one at the bottom calculates it exactly the same. However, if you were to put it in on your calculator, we're going to run out of time, it would give 48,000 adverse. It's the wrong way around and formatted incorrectly on there. Hence why we get 2 out of 2 on there, and we're absolutely spot on. We're out of time. We're going to have to close it now. Next, I'm going to have to exit as if I was you. Are you sure you want to exit? Yes. Whew. 1:59:57. Your result, 98% pass. Marvellous on there. Bit of a rush at the end, I'll admit it. It would be nicer to have a bit more time to explain it in a bit more depth. But But hey ho, you can have a look back at that other question that we missed out and flagged. But at the end of the day, would you be happy with 98% and a lovely pass? It is so time pressured, this exam. But I'm trying to explain it through with the insights as well. So if you are still watching at this point, I hope you've enjoyed it. It's been a lovely Friday. Feels like a Saturday now. We've been here for 2 hours. Feel free to give the video a massive like and thumbs up. Thank you so much for all the support. I hope the tips have helped as we've gone through. Leave me a comment below how you're getting on with your management accounting exam, how you got on with your result. And as ever, be sure to subscribe so you get access to all my free materials, because it could be the difference in you passing your next exam to get you through. Leave me any comments with any other video requests, and I'll do my best. It seems like the room's actually got darker since we started as well, but I hope it helps. It could be the difference just getting those few little marks like we walked and talked through, especially on Section A. But as ever on that bombshell, we'll see you next time. Cheers!